Right, well, should we get started? Welcome all, and thank you very much for joining us for another installment of a global liquidity update. I shall now hand over to Michael.
Good, thank you. Good morning or afternoon, everybody. Thank you for joining. This is the second of these calls we're doing. We did one earlier to Asian audiences earlier on. This is an update of our June liquidity data. It's entitled, It's a Big Beautiful V. That is effectively a description of the background, not necessarily the economic background, but I think the economies are generally following a few steps behind what the liquidity picture is saying. To sort of cut to the chase, if you look at the first slide, what we've got here is a summary of the data. The bottom line is that global liquidity, our index of global liquidity, which covers 80 countries worldwide, rose again to the end of May. It's now, that's a normal index range between 0 and 100. So liquidity is abundant. And I think you just got to look with, look at the evidence around. For example, in the last 2 months, there's been a very sudden and sweeping repayment of revolving credit lines in the US, with credit card bills being paid down by a whopping $1 trillion over those 2 months. So cash is abundant. US Fed liquidity is leading this charge. The Fed liquidity index is up at 90. That's similar index levels to where it was in 2008 after the global financial crisis. And it seems very likely to us that the Fed's balance sheet, which is already about $6 trillion, could test 10 trillion by the end of this year. Moving to investors' risk positioning, the key point here is that we still believe that investors, in terms of their risk asset holdings, are still positioned pretty cautiously. There's a lot of cash in portfolios. Institutional cash readings in the US have actually jumped by about $1 trillion since the lockdown. So there's a lot of money out there, and clearly the Federal Reserve and banks are feeding that cash in. The bottom line is that investors are going to start to move more and more risk on, in our view. Yield curves are likely to steepen further. If this is a normal cycle, it's entirely feasible that the US curve could steepen by another 150 basis points. So there could be an awful lot to go for in terms of that move. Finally, in terms of sort of the bigger picture, capital flows are beginning to move into the dollar. The capital flows that moved into the dollar are now showing signs of rolling over. We think that makes gold, the euro, attractive. I'll turn to a little bit later, is that if you look at the emerging market background, it's nothing like as dire as many of the commentators were saying 4-6 weeks ago. There hasn't been a huge exodus of money out of emerging markets, as some originally suggested. The evidence is simply not there. If you look at the picture on this slide 3, it basically updates our normal global liquidity index. It shows the strength of this V formation. The V formation basically began to gather steam during the second half of 2019. That was largely spurred by the Fed and the breakdown of the repo markets around the summer of last year, but clearly it's got a lot more impetus in the last 2 to 3 months. So you can see the scale of that. It's very unusual that we're up at these kind of levels, looking at the historic picture. But there's no sign, and certainly no sign from the FOM statement yesterday in the US, that the authorities have got any inclination about dropping liquidity injections off. In terms of the picture from a heat map, this heat map, which may be a little bit difficult to see in detail, but the impression is certainly there. This is looking at major economies. The world is the top line, then it says developed markets, then emerging markets, then US, Eurozone, China, Japan, etc. Broadly speaking, what it's showing is the turn in liquidity, which really came with gusto from the second half of last year, but particularly through the last 3 months. China is lagging. Japan is more or less shadowing what China's doing, so it too is lagging. The emerging market line, third down, is effectively colored by what's happening in the dominant economy. Outside of China, other emerging markets are beginning to increase liquidity. they're being paced by the US or overtaken by the US, but they're basically picking liquidity injections up. India is already at the forefront of that. It's certainly injecting cash into its markets now, as is Mexico. So you've got a lot of signs that this recovery is broadening out. It's led by the Fed, but basically most central banks are injecting liquidity into the system. On the top right, there's a little chart I've called Memo Capital Flows to EM. That basically shows the monthly pattern between Chinese net capital inflows, or in the case here, outflows, and that for all other emerging markets. The reason we've highlighted it is that although there was, plainly a big drop in March, a little bit of a recovery in April, and a further drop in May, the scale of these falls is really nothing relative to what we've seen before. It actually fits into the pattern that you've seen since 2015, nothing particularly extraordinary. And if you scale it relative to what happened in 2008, the outflows from EM are running at about a third of what we saw there, both in terms of the average over the period and in terms of the peak outflows. So this is not the sort of disaster that some people are painting. And the difference being this time is that the banking systems are more or less intact, cross-border financing is actually working, and there's no real problems about funding. The Federal Reserve clearly has helped that by pumping a lot of dollars through the swap markets. If you take a look at slide 5, that does highlight the China situation, and China is, well, it seems to be a bit of an enigma at the moment. The chart on the left is looking at Chinese daily operations in the money markets. This is actually a rolling 90-day net liquidity injection chart. You can see that around the early part of 2020, when the COVID virus was already hitting China, the People's Bank injected quite a lot of cash. They've taken that out again pretty much, so we're back at normal levels. Pretty much every day now, the PBOC says in its daily statements that liquidity levels are more or less adequate for the Chinese economy. And, that is, that may be the case. The policy mix that they're adopting, curiously, or maybe not so curiously, is one that is normally attuned to a policy of trying to stabilize the yuan against the US dollar. Typically, what China does in those kind of periods is to keep central bank liquidity pretty tight, which is what they're doing, and to relax much more at the fringes through reserve requirement easings, directed lending programs, and trying to get liquidity out into the fringe banks, such as the agricultural banks or other policy banks. And that's pretty much what they're doing right now. So if you take a look at broader aggregates of Chinese liquidity, and in fact, data came out today for the month of May, what that's showing is an acceleration in broad liquidity. In fact, over a 3-month period, broad liquidity in China, seasonally adjusted, is rising at about a 20% annualized clip, which is the fastest growth for about 4 years now. So it seems as if they're trying to goose the economy through those means, but it's not really coming through the People's Bank. That likely will be a question of time. The chart on the right I just put up just to make the point that if you look at how China has operated monetary policy over the medium term, the black area on that right-hand chart is domestic asset purchases, in other words, open market operations in Chinese money markets. The orange is foreign exchange reserves. What we've seen pretty much over the period, certainly since the end of 2014, is that foreign exchange reserves have kind of flatlined at best, if not drifted down. That's taken a huge impetus out of the ability of the Chinese to generate liquidity. It's forced them to go to domestic instruments. Effectively, you might say that the People's Bank, as an active money creator, only really started in business in 2014. So if you draw the parallel with the Federal Reserve System, which started in 1913, China here is about 100 years behind. But effectively what they're doing now is they're actively creating liquidity through the People's Bank. So People's Bank watching, PBOC watching, has got to be an increasing skill. And you can see the scale to which they've increased their activities really over that 5-6 year period. To take a look at the following chart, slide 6, that's looking at risk appetite, as we call it, which is risk positioning in markets. And what this is basically highlighting are indexes which show the amount of risk assets that investors are holding in portfolios. This is data we get in detail from stock exchanges, from administrators, and whatever. But it basically is based on actual holdings data. What the picture shows is the drop-off below zero, which is the long-run neutral line between risk assets and safe assets, into a regime, negative regime on the left-hand chart, where you basically can see investors holding lots of safe assets, and their appetite for risk has really dropped right down. And it's dropped down to levels which are almost, well, in fact, are off the scale relative to history. We've got this data running back right to the early 1970s, and these are the lowest scores we've pretty much seen. Nowhere is that truer than if you look at the US and you look at the right-hand chart and look at the grey line, which is basically US investors' appetite for risk, and just look at what happened to that in the early part of this year. With the low there in March. Basically, Wall Street really sold off because investors were shifting heavily out of risk assets into the safe assets. I gave the evidence of flows into money market funds. They're still rising significantly, but that just illustrates the scale to which US investors switched out of equities into safe assets like bonds or cash. That has not had any parallel historically. It's a unique experience, but now we're starting to see that rebounding back again. So at the moment, investors are still well below their normal allocations to risk assets at a time when there's huge amounts of liquidity still in the system. To scale that, and this is where we think investors were broadly speaking wrong-footed back 2 or 3 months ago, is really judging the scale of what the authorities, and particularly the Federal Reserve, has done. What I've got on the left-hand graph is a comparison between what's happening in terms of broad liquidity growth now on a weekly basis in terms over 3 months. And what this shows is that we're looking at growth rates of well over 100% for liquidity on that annualized metric. If you look at the absolute amount of liquidity that was injected, basically over the period from end February to June to currently where we are in June, what you've got is a 17% increase in broad liquidity so far. If you put that into context with the black line, which is 2008-9, there was nothing like the same increase, even on an annualized monthly basis at the time of the GFC. And effectively, broad liquidity only increased by 4% over that period from October through end January 2009. So the scale is just massively different here. If you look at the right-hand chart, that shows it even more dramatically. This is flows into US institutional money market funds, which is actually one component of that liquidity story. And it may be the one that's the most important for the market in many ways. What this shows is the scale of the exodus from equities into cash over the period of the COVID lockdowns. It's absolutely whopping compared with what happened in 2008-9. And if you look at the title of the chart, what it basically says is that through January 2009, US institutional money funds actually lost 9% of their assets through that period. Whereas if you look at what's happening now to end June or mid-June 2020, you've had a 42% increase in institutional money funds. And that's over $1 trillion. So the scale is just huge. These two charts are also illustrative of what we're trying to say. The left-hand chart is kind of dramatic in a way. It tells a story though. And what it's showing is a track of the growth rate in dollar terms of our global liquidity aggregate projected through year-end 2020 using the slated increases that we're pretty sure will be coming from the Fed, ECB, BOJ, etc., all the major central banks, and applying what is a normal multiple to global liquidity. And what that basically says to us is you're likely to get something like a 30 to 40% increase in global liquidity this year. This is, as I say, projecting through end December. And that is compared with the growth rate of world financial assets, in other words, financial asset returns. Now, if you look at the two lines, there seems to be visually a very tight correlation. In truth, if you drill down on a month-on-month basis, it's a bit less impressive than that. The correlation coefficient is about 0.7, in other words, an R squared of about 50%, but nonetheless pretty good. And likely to see is a fairly significant rally in financial assets given the amount of liquidity around. The chart on the right scales that for equities. Now, all we've done here is to use a metric that we favor and have been using for many years, which is what we call the price to money ratio, which is effectively the total value of all equity holdings worldwide divided by global liquidity. And what that basically shows, statistically at least, is mean reversion, a very clear mean reversion, to a level of about 0.55 or 55% on that chart. We've projected where this will be by end 2020 using the current value of equity holdings worldwide divided by the pool of liquidity we project by the end of this year. What that is showing is a reading currently of about 0.37, so it's still well below where we are now, but also where the long run average is. In fact, if you go back 4 to 5 weeks, that dot was down below 0.3. So we've already rallied quite hard, but it looks like it's moving up towards some sort of mean reversion level. So if you look at the liquidity background, risk assets are really what you've got to start thinking about. Let me turn to some of the implications more broadly. Slide 9 is looking at data which comes from two sources. One is the orange line, which looks at interest rate expectations taken from the term structure. What we've done here is to look at the projection of medium-term interest rates that the term structure implies after taking out term premium estimates. So what this is saying is that you've seen a significant uplift in rate expectations, but in a way that's not really saying any more than the fact that if you're lying your back at zero interest rates, things are kind of looking up. Rates are more likely to rise than not. I think what we saw out of the FOMC statement yesterday was a determination to keep rates flat for some time. I think the interesting pointers were that they've almost 100% ruled out negative interest rates. I mean, that's certainly, if you look at the dot plot diagram, no FOMC member was anywhere near that projection. So I think that's dead. And the other is that yield curve control basically was not really entertained. I mean, there's lip service given to it, but there was no announcement, as many people argued. The sort of consensus view that many of the investment banks are saying is that it was dropped because of the strength of the employment number. I kind of doubt that, really. I don't think the Fed has been, in a way, that serious about yield curve control, really, because I think it's very, very difficult for them to benchmark and actually make it work. And I was on a Zoom call with Jim Bullard about 3 or 4 weeks ago, and I did ask him a question about, are you going to enact yield curve control? And he said, we don't think there's any need to do it, because very strangely his answer in this regard, he said he doesn't think the markets are focused on rates that much. So anyway, that's as we are. The blue line, which is actually more interesting in a way, is looking at economic expectations that come from basically all the Federal Reserve and Michigan consumer surveys that are published. And what we do is we look at the gradient between expectations 6 months out versus expectations now. And what it shows is a very consistent pattern, that the belief is that there's going to be a very sharp rebound across the US economy over coming months. And that has actually been a very, very good heads up as to what will happen to yield curves looking forward. In terms of that yield curve story, this is our take. This is what we've been arguing for some time. Liquidity drives the yield curve. The blue line here is our US liquidity index advanced by 6 months. it shows a very, very clear and solid relationship to the yield curve. In other words, as liquidity expands, what you'd expect is a steepening curve. I've been using this relationship for more years than I care to remember, having used it originally at Salomon Brothers in the late 80s. It continues to work phenomenally well. And what it's showing is that as liquidity rises, within the next few months, the yield curve begins to steepen broadly because you start to see that liquidity working through the economy and term premium beginning to rise as investors start to move more and more towards risk assets. Risk-seeking behavior picks up and the yield curve steepens. And so if you look at this relationship, it strikes us that it's entirely feasible that you're going to be seeing a lot more curve steepening, which has got to be good for financials and profit margins of banks. Banks are no longer the problem; they are the solution, as we keep saying. If you look at that term premium, just to show how much bond markets are out of line here and why bonds are not the asset to own, just take a look at this chart, which is looking at the nominal term premium on the US 10-year. And what we've shadowed here in the chart are the sort of grayish areas are periods of QE, with the latest one, which began, let's say, after the repo crisis last year, shadowed there. But, this is the one that we've got currently since March is the one that's really going with a gusto. But that seems to be suggesting that every time there is a QE, you get a steepening or a rising term premium. And every time you get QE off post-GFC, that term premium drops. And that's really what's behind the movements in the yield curve. Let me say something about a broader picture about what's happening to currencies and how to frame this in terms of equity markets generally. If you look at this slide, this is looking into the entrails of what we do. This is splitting in the US, in this example, Federal Reserve liquidity in blue from private sector liquidity in orange. The private sector liquidity data is basically all sources of cash generation. It is household savings, corporate cash flow, borrowings from banks, borrowings from shadow banks, and everything is lumped in there. It's effectively a Z1 measure from the US flow of funds accounts, and basically it shows the cash flow generation of the US private sector. The blue line is Federal Reserve liquidity injections, plain and simple. What we argue here, and the reason it's called the quality theory of money, is that what it's looking at is effectively a hierarchy. Policy liquidity is bad liquidity when it comes to the currency. It may be quite good liquidity when it comes for risk assets, but for currencies it's bad. And if you look at private sector liquidity, for a currency perspective, that's very good. If you've got the US private sector generating cash, people want to earn the dollar. If you've got the Federal Reserve pumping in liquidity, people don't want to earn the dollar so much. And therefore, it's the differential between these two, the gap, which is really important for the currency. Now, this is an example of that. This is our leading indicator, which is what we call our Forex risk indicator, which is exactly that metric, which is looking at private sector minus central bank liquidity. What we've done here is to look at a long-term chart of that metric, and we've run it all the way back to the 1970s. We've fitted a sine wave, which shows a 6 to 7 year cycle, and the grey shaded areas are periods of dollar weakness 12 months ahead. So it's trying to show that it's a leading indicator. And what this is saying is the dollar is beginning, or the flows into the dollar are beginning to roll over now, which is suggesting that investors ought to be starting to think about other currencies, mainly the European currencies, we think, and gold. If you put this framework together about what does it mean for fixed income and for currency markets first, and then I'll turn to equities, what it's basically saying is that there are two dimensions that we look at. We look at private sector liquidity and we look at central bank liquidity. And it's the divisions which are very important, as the four cells in the matrix highlight. Basically, what we're arguing here is that those two asset classes, fixed income and Forex markets, are very strongly driven by liquidity factors. Psychology or investor behavior don't really play a big role in those markets, why it's often very hard to be a contrarian there. You've got to look at what the flow is saying. If you're in the top right diagram, which is where we think we are now, you've got very high central, very high private sector liquidity, which is normally when bond yields rise, largely because term premium are expanding. The opposite quadrant, bottom left, is when yields fall. That's what we've been in for much of the last 5 years or so. And again, it's term premium that pulls down. If you're in the top left, that's when you tend to get a very strong dollar. And that's a period where the central bank is tight and where private sector liquidity creation is abundant. And then correspondingly, bottom right, exchange rate weakness, that's when you get private sector liquidity low, central bank liquidity high. That was a period in the US in the late 1970s, and obviously after the financial crisis in 2008. Now, if we put a snail diagram on that, you can see pretty much how it moves. The interesting point is that we spent most of the last few years in that lower left-hand box. There have been a few years when the dollar's been strong, 2013, 2016, when we've been in the top left. We're now in the regime which is saying that bond yields may be starting to rise again, the 2020 point, and we haven't really been in that exchange rate weakness area really since 2010, 2011. And that's broadly how we see things. Now, in terms of the equity response, we tend to think that if you look at how growth and value stocks perform, if you're on the left-hand side of that diagram, when you've got low central bank liquidity, that's normally when growth stocks outperform. If you're in the right-hand side, when central bank liquidity is high, meaning you're either getting rising bond yields or a weak currency, that's when value starts to outperform. So we think we're moving into a regime where value is starting to come back to the fore. And if you go back to my earlier diagram, what you'll see there is that that hasn't really been the case, since the early 2000s, in truth. So it's a long-term period we've been in the growth phases. Now, let me just finish up on a couple of themes, and then I'll see if there are any questions. This is saying, what about inflation? The rates of monetary growth that we're looking at worldwide, with liquidity slated to increase by maybe 30 to 40%, and similar, if not higher figures for the US this year, are clearly, I think, a threat to inflation. What the Federal Reserve was saying yesterday, in my view, is that they're fully prepared to take risks on inflation. And the question we've got to ask is, will inflation come through? Now, the bond markets are absolutely adamant that it won't. The consensus opinion among US economists is that it won't. I'm not so sure. And I think that we've got to be open-minded about this. And what I've shown here is a chart, in fact, starting on the left-hand slide, which is looking at supplier delivery time. A series which comes from the ISM, the Monthly Purchasing Managers Index in the US. One of the component questions, which is saying, are you going to get lengthening delivery times? And the example in the 1970s and 80s is that this was a pretty brilliant indicator 12 months ahead. The orange line there, supply and delivery times, has been shifted on 12 months. So it basically picks up a lot of the inflections in the US inflation rate. Alan Greenspan, remember him, he used to say this was the best leading indicator of inflation he'd ever found as an economic forecaster. And, it seemed to prove its worth. If you look at what's happening now, there's an interesting conjunction going on. The blue line on the right is US CPI inflation, the latest data put in there. And the orange line is supply delivery times from the ISM shifted forward 12 months. Now, that would make me a little bit more concerned than the consensus that we may be getting some pickup in inflation. So that's one of the things that I think one's got to think about, particularly now in the context where the dollar looks as if it's had its best days. It's beginning to roll a bit. And although we don't think there'll be a collapse in the dollar, this is something that one's got to be aware of. Inflation could come through simply because it's the lower or very narrow monetary aggregates that are really rising fast. And to come back to my point about US credit card bills, the alacrity with which people have paid off their credit card bills would suggest that there's a lot of cash around at the retail level. And, if you've stood in a queue to buy goods of late, you know that people are not really interested in discounts. They're interested in getting what they want. So there's a heads up warning coming through there, and that could spell danger clearly for the bond markets. What does that mean for asset allocation? Well, this goes back to some work we did many years ago. It's published in the book that I recently wrote called Capital Wars as a theme, but it basically is showing asset allocation based on the inflation rate, which is shown on the lower axis. The data on the right comes from Robert Shiller's CAPE estimates from his website. All we've done here is to basically join the dots between the CAPE index and 5-year average of the CAPE index and US inflation rates. And what it shows there is that there's a very nice regression fit that you can get, which is like a humped curve, showing the fact that equity valuations are highest. The north-south axis is the PE multiple, or the CAPE estimate, and it shows you get a peak PEs around about 0.1% inflation or thereabouts over time. And either side of that, with higher inflation or higher deflation, you start to get lower valuations. On the left-hand diagram, we put that into context with bond markets. The red line is the implied multiple assets. And what this basically says is that as you shift from a zero inflation rate towards higher inflation or moderate inflation, you want to be scaling down your bond portfolio, increasing equities, probably increasing some real assets too. Once you get beyond about this sort of 5-6% inflation rate, financial assets start to deteriorate significantly in terms of performance, and real assets pick up. So you've kind of got three regimes there. You've got deflation when bonds look great. You've got low inflation, which is a mixture of bonds and equities. You've got high inflation, where it's real assets. We're not at the high inflation end anywhere near that yet, but I think we may be moving from the left towards the right of the diagram, which suggests you want to be having less bonds and more equities. As a final thought before I open this up to questions, what about yield curve control? Well, it may be a dead issue now after yesterday, but let's just bear it in mind why it's a challenge for the Federal Reserve. And that is that if you look at the period of successful yield curve control in the 1940s to early 50s, in fact, the period from 42 to 51 was when they enacted yield curve control. That was very successful, but the backdrop was very different. Then, if you look at the pie charts, US banks owned 41% of the treasury market. The Fed owned 1%, so they could clearly buy a lot. And you had a situation where foreigners owned barely 1%. Where we are now is that foreigners own 40% of the bond market. The Federal Reserve is up towards 20%, and banks own barely 4%. So it's much more difficult to control. And again, if you look at the mix of banks' balance sheets, they've got very few treasuries, 4% of their assets in treasuries now. Whereas if you go back to 1945, it was 62%. And then a little warning flashed up on the right, which is what is the latest data on foreign ownership of treasuries? So if you break down that 40%, what we've shown there is who owns US treasuries. And what I've done is to look at basically 3 or 4 groups here. One is China and Hong Kong, which basically own just under 20%, which is that sort of darker brown segment. Then you've got what I've called the S15 group, which is the name I give to those countries that are basically involved in the dollar swap mechanism that was announced in March, the group of friendly countries, including the US, so 14 others plus America. They basically own just over 50% of the bond market. And then you've got other US allies and others. The other US allies are countries like Israel, Taiwan, Saudis, etc. And then the other segment. So if you put this into context, you've really got to say that more than a third of the US Treasury market is owned by potentially hostile nations who could decide to do something untoward, like selling treasuries in the medium. So the difficulty of controlling the yield curve is really these challenges. Now, let me dive out of this and get back and see if there are any questions that are coming up from anyone in terms of you can use the chat, or and I can unmute you if you want to ask any questions.
Thank you very much, Michael. Yes, if anyone has any questions, then feel free to put them in the chat and Michael can patch you through. I think we've got one there from Michael Showell, if you want to patch him through.
Let me unmute. Hopefully that's...
Thank you. Hey, Michael, how you
You're
doing?
on, Michael. Hi.
Good, good, good. Yeah, I had a question about China and the kind of stimulus that they're performing. I mean, it seems to me that right now it involves much less of an explosion of money supply than, say, 2010 and 2016. And it's much more dependent on fiscal, particularly this sort of massive issuance of local government bonds. And whether one of the implications may be that, if you want to play a China recovery, whether it's better to use external markets, whether it's industrial commodities or say somewhere like Latin America, rather than China's equity market directly, because you're not going to have the same kind of explosion of local asset prices. It's almost back to how we used to look at China, say in 2002-3, when we believed it was growing, but we didn't view it directly investment.
Yeah, no, I agree. I think that's pretty much what's going on. If you look at, as I say, if you look at the latest data that came out today, which is what's generally called the social financing data, the trouble with that total social financing is there's a lot of double counting in that, and actually some bits are also missed out. But if you adjust the data to get a more meaningful number, there's been a very clear step up in broad liquidity growth to about 20% annualized year over year. Now, if you drill into what are the bits that are really moving there, what they're doing is that they're encouraging the policy banks to lend more, which is basically saying, let's go down this Belt and Road Initiative story again. And they're pushing money out to where it's needed, which are things like in the provinces or areas like the agricultural banks. So they're deliberately not using the People's Bank as the main source, the main hose, if you like. It's much more directed lending. Well taken. And I still think in the medium term, or let's even say the medium term, let's look at the short term. China has to internationalize the yuan in actually a faster way, maybe since COVID, than they were thinking before. This has been an aspiration, as we know, to do. But basically what all China has to start to do now is to increase the invoicing in yuan of goods. Being the biggest mercantilist economy worldwide, this is something they can easily do. They need to open up their bond market, which may be a little bit more tricky given the statements out of the administration. And they need to develop a digital yuan to use, which they're clearly doing. Now, the point about invoicing is a critical one, and that is something that could be done very quickly. It was actually the route that the US took to actually internationalize the dollar after World War I. What the Brits did during the war was to say there was to be no more lending from British banks to anybody outside the empire, which meant American banks could come in with alacrity, which they did. They basically began to use trade financing as a vehicle. There was a trade credit market developed in dollars, and there was an opening up of US capital markets for foreign bonds. And that basically led the dollar to become the main currency of the world in the early 1920s. But one of the things that, maybe it's something to maybe reinforce here is that this can happen very quickly. In 1914, the dollar was quoted in fewer markets than the Austro-Hungarian krona. But by 1925, when sterling went back onto gold, it actually de facto went to the dollar, because sterling was quoted not against gold, but against the dollar as $4.86. And that showed that the dollar was the paramount currency. Now, the point about this is that this happens quickly, and the root is trade invoicing and a trade credit market, and China could do that quite quickly. And all I would say is sort of as a last point sort of as a hook here, why has China been going around for the last 2 or 3 years around Central Asia, encouraging all of these countries to develop swap lines with the PBOC? That must be to do with some thought about trade invoicing in the future, because that's what they need these credit lines for. So I think it's happening. And I think you're absolutely right. And I think the whole point here is that China is emphasizing its broader regional footprint, which is what the administration, what spooks the administration in the US.
Thank you, Michael. That's a great answer.
Good. A question from Chris. Let's see if I can unmute you here, Chris. Chris, do you want to answer that, or shall I just go for it? Maybe he's okay.
Thanks.
Okay,
Thanks.
go for it,
Michael. Appreciate it. Look, I think we've been in positioning and risk appetite, and your measures of risk appetite are some of the that you see. There seems to be a fair range here. One of the things that you were talking about earlier.
So you're breaking up a bit. So I'm going to anticipate what you're saying because you put it in the chat. But it's about risk appetite, and what you're saying is that, I think if I understand correctly, is that part of the increase in liquidity is because corporates are taking down credit lines, and if you go outside money market funds, what's driving the risk appetite index lower? So let me take both of those 2 points separately. I think it's undoubtedly clear, undoubtedly true, but what's going on here is that part of the increase in liquidity is that credit lines are coming down. That's for sure. But I think it's more than that. And if you look at the scale of the increase in lending, it's a lot bigger than we were seeing in 2008. So I think it's kind of beyond credit lines. And another sort of heads up to that, which may or may not be a correct indicator, I'm not sure, is that if you look at the commercial paper market, which basically surged, perhaps with good reasons because of the support in 2008, it's kind of died away now. And that would suggest that there's a lot of liquidity in the system, and so corporates don't really need to strain too much for it. So I think that there seems to be a general, if you like, robustness in terms of corporate cash flow. Already, if you go back to the same timeline in 2008-9, you would have seen the beginnings by now of a collapse in corporate cash flow. And what you saw last month on our data was continually high levels. So we had been fearing that there'd be a collapse in private sector liquidity, but it doesn't seem to be happening yet. So again, this seems to be a different dynamic. And I stress the point that, again, that if you look at the comparison with 2008, the scale is much different. We're looking at about 4 times the effective monetary stimulus that we saw then today. The second point, which is why you've got a fall in risk appetite indexes beyond the money market funds. It's, part of it is in truth the fact that liquidity has basically expanded from a number of sources. That's true, but there's also been a big increase, big increase in holdings of safe asset bonds. So there's been a lot of movement into treasuries, and there was a sizable move out of equities. Now, part of the equity gamma trading, and there was a huge amount of gamma trading that was going on ahead of this correction, which basically caused a lot of forced selling. And I think that is becoming more and more a feature of markets, which is why I think that if you come back to a way that we tried to characterize the markets a few months ago before the COVID crisis, we said that the structure that you've got because of this changing liquidity dynamic is that markets tend to sort of climb a gradual slope, but they see these very sharp crevasses. We had seen one, and which is why we wrote about it, in the summer of 2019, and you basically see a sharp drop. The gamma exposure of the market forces people in a sell-off to sell even more, and so you get this dive down in the market. Dealers step away, markets become illiquid temporarily, and then they climb back up. And we've seen this, haven't we, sort of a number of times in the last few years. So I think that's a trait that's with us. So I think that if you come back to the structure, I would say that looking at the asset allocation data that we see, equity allocations generally are below average. On the equity to liquid asset ratio that we track, the normal average worldwide is about 0.55, and we're currently at levels of about 0.37. So we think that there's scope to rebuild. And part of it is a fact as well. We don't like fixed income, but that's an asset class which has been heavily bought into over the last few months.
Thanks very much. Appreciate that. I think the equity assets to liquidity is an interesting chart and concept. And I would assume that given the 30 to 40% liquidity surge that we're going to see this year, if this thing were to rebound back to, you've got a projection of below 40. If this thing goes to 60, that would imply a pretty significant bubble. Well, I guess you wouldn't necessarily call it a bubble in this metric, but it would be, it would, I don't know if it's reverse engineered what a move to 60 or 70 on your equity assets ratio would imply for, say, the S&P 500 price, but I'm guessing it would be considerably higher from here.
Yeah, I mean, it would be 40-50% up, I would think. It would be a significant rally, but I think that although that may be a fanciful suggestion right now, but if you get inflation fears starting to spook the market, investors moving out of bonds, there could be a lot of mileage in people shifting into equities. Particularly some of the value equities which have already been out of favor. So I think that's not necessarily infeasible. And then if you go back to what Governor Powell or Chairman Powell was saying last night, it strikes me that the Federal Reserve is, well, I'm not saying deliberately creating a bubble, but it's saying that it couldn't really care less whether it did or not, because it's saying that what it wants is the employment, recreating employment is really the number one priority right now. Bubbles, as Greenspan used to say, bubbles can be cleared up afterwards.
Thanks, appreciate it.
I noticed there's a question from George Fox. If you want to,
Hi, Michael.
George.
Can you hear me all right?
Yeah.
So just as it says in the question I asked, that I saw a survey that said 43% of borrowers don't expect to repay the UK bounce back loans, either because they'll be bust or they just don't have any intention of repaying those loans. And I would imagine that you're probably seeing similar things in other countries. So do you not think that potentially this kind of solvency problem might not override this liquidity boom and cause a shock in the market in the recovery?
Yeah, I think I don't want to be. You make a very good point. I mean, I don't want to be complacent about solvency. It's an issue. I think the only thing that I would say, which is, treat this as a slightly tongue-in-cheek comment. I mean, solvency. In all the years I've been in the market, solvency has been spoken about an awful lot, and there have been very few occasions of countries that become insolvent. Generally, it's much more an illiquidity problem. That's what tends to sort of appear first. Now, as I say, I don't want to be complacent about that, because clearly it can be an issue in certain industries or certain firms, and that may well be the problem. But if you look at the policy background that is being enacted or has been enacted up until recently, it's really been one whereby the private sector has been encouraged and incentivized to take on more and more debt since GFC1. And that's been the case because governments have been running austerity policies and trying to get into surplus, by which means that's putting the burden more on the private sector. And low interest rates are clearly incentivizing the private sector to take on more debt. And that creates a bigger and bigger debt mountain and really, raises the stakes in terms of your insolvency problem. The issue that we kind of come back to in this is that although you may have that issue about insolvency, The real question that sort of bites on the markets is that debt has to be refinanced. And it's making markets more and more refinancing mechanisms rather than new financing mechanisms. So if you've got 360 trillion roughly that you've got to refinance every year, that takes a huge amount of balance sheet. It doesn't matter whether interest rates are high or low, the refinancing needs liquidity. And that's what central banks have basically, until recently, missed out on. So periodically, you get liquidity crises because these burdens of refinancing swamp the available liquidity in markets. Now, where we are looking forward is that banks running whopping great deficits have actually, in a way, cured this problem, or partly cured the problem, because those big deficits are going to transfer a lot of wealth to the private sector. Now, it's entirely feasible that what we're seeing here is an increase in the debt burden globally, but that will be more and more taken up on the shoulders of governments, and where there's probably more capacity on the private sectors. And I think that makes a big difference. Now, at the end of the day, does it mean that you're going to get financial repression policies to try and alleviate that debt burden? Well, I think that's entirely feasible. That's quite possible. So it may well be that if you look at the metrics or the arithmetic of how you get debt down, what you need, and this is looking at the recipe of how the US did it after World War II, is you have an initial little burst of inflation, okay, which gets you started. And then what you do is you basically try and run primary budget surpluses, or you basically keep primary budgetary control. And that gets your debt burden down pretty quickly. For the US went from, if I recall, over 100% of GDP after World War II to under 30% within about 25, 30 years. So that was a remarkable achievement. And, you know, I think that sort of blueprint will be taken out again. So that's why I think you've got to watch out for a little burst of inflation initially, and then you see this sort of financial repression coming through. So that's what I would tend to think is the outlook, which makes me think that bond markets are not really going to be great performers in this environment.
Great, thanks. I just had another quick question on something you said in response to the previous question about the value names potentially having a bit of run. I mean, is that more from a perspective of they're currently just, you know, completely unloved and the money needs to go somewhere, and obviously on the other side of the boat, the growth names have had a pretty strong run? Or is that because you feel like the environment for which, the environment might be more conducive to value name? Because I
think it's the latter.
Yeah.
It's the latter, because basically what we were saying was that if you look at pretty much the last 10 years, what you've been since the global financial crisis, what you've really been in is a regime where central bank liquidity has been, let's say, stuttering, but generally not that generous. I mean, there was the big burst in QE1, there was a little that explains to our mind why you've had collapsing term premia going on. Now, that backdrop of falling term premium and falling bond yields and a firm dollar has really played into the growth stock story. That's what they like. Okay, if you, and the allied point is that there's been a shortage of safe assets in the world. So what's broadly gone on is that people have been buying US AAA or high quality corporate names as a substitute for government debt, and that's further helped to wing Wall Street upwards, because there's been a lot of share buyback ability as well. If you go forward, I think what you've got is a different environment. The amount of safe assets in the system is going to go up dramatically, so you won't be getting the share buybacks going through, I don't think, again. You've got the prospect of rising yields in the bond markets, which is going to hit the growth stock area, and you've got allied to that, you've got a steepening yield curve, which tends to help value. And then you've got the possibility of the dollars rolling, which will help EM and will help commodity prices. And the question is that I don't think the US authorities want a strong dollar, and I think that was the clear message that came out in March, given the alacrity with which they shoved money down this swap line pipeline. And that said that they they don't want to take that risk. So I think that we're in a period now where investors are going more risk on. The dollar is starting to roll over. Don't think the conditions there for a collapse in the dollar yet, but clearly one's got to have in the back of one's mind, if this conflict between China and America starts to escalate, there may be tensions on the dollar. That's sure. But I think value comes out of this, rather better, in fact.
And so what kind of timeline are you talking about for that? Are you talking, a year, 2 years? Are you talking 6 months? Or
you mean how long it will last or how long it will take? I think well, let me answer both questions. I think how long it will last, I think we could be in a regime where central bank liquidity is certainly generous for the next couple of years. I think that's what the story is. Notwithstanding the thing one's got to be careful of, having said all that, is worrying inflections in the pace of central bank liquidity if they get nervous over inflation or whatever, or if to pick out something Stan Druckenmiller said, I read on the tapes a week or so ago. He was concerned about the imbalance between coupon issuance by the Treasury and the speed of Fed buying. He reckoned there could be an inflection because of that. Sure, it's possible. So these things one's got to be alert to. But I think we're in a window of a couple of years when central bank liquidity is going to be pretty generous. And in terms of when will it start, well, I would have thought you're starting to interest coming back into value names now, just looking how the market's moving.
Great, thanks.